The main development since our last report in February has been Russia's unprovoked and illegal invasion of Ukraine. The Bank of England condemns Russia's actions and the suffering inflicted on Ukraine. The bank is working closely with the UK government to support its response in coordination with international authorities. Global inflationary pressures have intensified sharply in the build-up to and following the invasion. This has led to a material deterioration in the outlook for world growth. Concerns about further supply chain disruption have also risen, both due to the invasion and to COVID developments, particularly in China. These developments have exacerbated greatly the challenges already facing the UK and many other economies from the series of adverse supply shocks that we continue to face. Monetary policy, therefore, must navigate a narrow path between the increased risks from elevated inflation and a tight labour market on one hand, and the further hit to activity from the reduction in real incomes on the other. While these shocks are global in nature, there are important differences in the way they are impacting different economies. To characterise the situation, the United States is facing what looks like a demand shock, with a strong domestic labour market, strong domestic demand, and relatively less exposure to the energy price shock, given its position as a major gas producer. The euro area, by contrast, is facing a supply cost shock as it starts with a somewhat weaker domestic labour market, and it's heavily exposed to the rising gas prices. In the UK, we're seeing elements of both. Like the euro area, we're experiencing a sharp terms of trade shock emanating from the rise in the price of tradable goods and energy. But our strong labour market is more akin to that in the US. We turn to the outlook for inflation in the UK. Turning to our latest projections, it's a forecast of two halves, with inflation well above target in the near term, but subsequently falling back to the end of the forecast below the target, as global inflationary pressures fall sharply and domestic activity weakens. This is similar in nature to our February forecast, although developments since then have increased the size of these swings. In line with the MPC's conventions, the projections are conditioned on a market-implied path for bank rate that rises to around 2.5% by the middle of 2023. That's 1.1 percentage points higher than in February, falling to 2% at the end of the forecast period. Wholesale energy prices are assumed to follow their respective futures curves for the first 6 months of the projections and remain constant beyond that. Given that path for wholesale prices in Ofgem's published methodology for calculating the retail gas and electricity price caps, bank staff currently forecast that household energy prices would rise by a further 40% in October.
This appears to be very close to a recession. I don't know how you define it. How can you justify to households hit by this cost of living crisis further exacerbating that in the middle of what looks very much like a recession?
I mean, I would come back to this analogy that I used and have used recently of this narrow path. And the challenge, of course, is that on the other side of the path is where inflation currently is, but more particularly the risks as we see them going forwards. And I would highlight, as we say in the minutes, actually, in the statement, that the risks are, if anything, on the upside, we think, to inflation going forwards. And that comes, I think, I would highlight two things. One, and pointed to it, that we have a very tight labour market. So, we have unemployment currently at 3.8%. We think it will actually go down somewhat. And, of course, it's interesting looking back, I think, over the last 2 years or so as to how much we now know. And I would emphasise now know because there was huge uncertainty through the COVID period on this question. And it's a very, very important question. But, of course, the unemployment path has been very different. And the labour market is very tight. I mean, I spend a lot of time going around the country talking to businesses. I'm sure you do as well. And frankly, the first, second and third thing they want to talk about quite reasonably is the tightness of the labour market, the challenges they're having in recruitment and what that means for pay. The second thing is I would highlight on this risks point is that one of the things we've highlighted before is that the COVID period did lead to quite a substantial build-up in unexpected saving in the economy. So the question, of course, continues, and under this new, if you like, setting of the state of the economy, is how exactly are those savings going to be used, and are they going to be used to sort of, if you like, buffer demand? But of course, then we have to look at that from the point of view of the risks to inflation. So the point being is we are walking this very narrow path now. And to your question, I mean, the approximate reason for raising bank rate at this point is not only, I mean, it's not only the current profile of inflation and what is to come, and of course what that could mean for inflation expectations, but the risks as well. And I would particularly emphasize the risks.